SCHD has been one of my favorite ETFs for a long time. Historically, it has performed extremely well, but this year, and honestly over the past couple of years, it has clearly underperformed the broader market in a meaningful way. But here's the thing. The entire reason investors hold SCHD is for its stability during bad markets, and we simply haven't experienced that kind of environment yet. So don't write it off. However, I've also found a strong alternative, or more accurately, a complement, to SCHD for the safer portion of your portfolio. And if you love SCHD, you'll probably be excited about this. Before we dive in, remember, all investing involves risk. This isn't financial advice, and I'm not a financial advisor. Why we need to talk about SCHD alternatives right now: most serious investors and analysts believe the overall stock market is extremely overvalued at the moment, especially when it comes to technology and AI. That's why many smart, long-term investors are rotating part of their portfolio into value stocks. This is exactly where SCHD shines. Very little tech exposure plus solid valuation metrics. But let me introduce you to another powerful option. Back-end index pointing right VTV, the Vanguard Value ETF this year. VTV is up 11.65%, while SCHD is down minus 0.51%. On the surface, they seem similar. Both are US large-cap equity ETFs, both track indexes, both are passively managed, both offer low expense ratios. VTV 0.04% SCHD, 0.06%, but once we look deeper, the differences matter. 1. Index and strategy differences. VTV tracks the CRSP US Large Cap Value Index. This is a pure value approach, regardless of dividend yields. SCHD tracks the Dow Jones US Dividend 100 Index. US companies with strong, consistent dividends filtered for quality, yield, and cash flow. SCHD equals value plus dividends plus quality screens. VTV equals broader, pure value exposure. 2. Diversification. VTV holds 300 plus stocks, broader, wider exposure to value, less concentration risk. SCHD 100 holdings much more concentrated due to strict dividend criteria, focused exposure, less diversified. 3. Dividend yield. A major difference. SCHD 3.8% yield, VTV 2.1% yield. If income is a priority, SCHD wins clearly. If total return and diversification matter more, VTV stands out. 4. Sector exposure. This is where things get very interesting and useful for building a safer portfolio today. VTV overweight sectors. Financials, industrials, healthcare, very low tech exposure. SCHD overweight sectors. Energy, consumer staples, healthcare, also very low tech exposure. Both funds have low tech exposure. Perfect for anyone trying to reduce over-reliance on AI-driven growth stocks. 5. Top 10 holdings comparison. VTV top holdings. JP Morgan, Berkshire Hathaway, Exxon Mobil, Walmart, Johnson & Johnson, AbbVie, Home Depot. SCHD top holdings. AbbVie, Cisco, Merck, Pepsi, Amgen, Coca-Cola, Lockheed Martin. Only 12% of VTV's total holdings overlap with SCHD. And about 36% of SCHD's weighted holdings overlap with VTV. This means they complement each other extremely well. 6. Performance. Short-term versus long-term. Short-term, the difference is massive. VTV is clearly outperforming SCHD. But long-term, 10-year view, their returns are actually very close, even when factoring in the recent surge in VTV. Dividend ETFs like SCHD tend to lag or lead depending on interest rates and investor sentiment. This is normal. 7. How these fit into a portfolio. 2026 outlook. This part is key. If your goal is broad value exposure, VTV is the simpler, broader, lower concentration choice. If your goal is income and dividends, SCHD is superior due to its higher yield and strong cash flow focused screening. VTV equals broader value, tilt SCHD equals value plus dividend plus quality, tilt. Both can be excellent together, depending on your objectives. 8. Allocation thoughts, growth versus value. Right now, many investors are overloaded on growth and AI. If you have 30 to 40% in growth stocks, you might consider shifting 10% into value. You can split that value allocation into VDV for broad exposure, SCHD for dividend strength. This gives you both diversification and stability. 9. Tax considerations. In a taxable brokerage account, dividends are taxed when paid, so lower yield VTV may be more tax efficient as SCHD's higher dividends may create a higher tax bill in retirement accounts. IRA, Roth IRA taxes are deferred or eliminated for Roth. SCHD can shine here due to its higher dividend yield. Simple rule of thumb: brokerage account, lean slightly VTV retirement account. Lean SCHD, both are fine everywhere, but tax efficiency matters. 10. Final recommendation for a long-term investor: if someone has a 10 to 20-year horizon and wants growth plus moderate income plus diversification, VTV may deliver slightly better appreciation with fewer dividends and lower taxes. If someone prioritizes income, stability, and long-term dividend reliability, SCHD is the clear winner, especially inside retirement accounts. Personally, SCHD remains my largest value position, and I expect it to stay that way for years. Yes, SCHD has underperformed recently, but that's exactly the environment where it's supposed to lag. When tech cools off and as interest rates continue to fall, dividend-focused value funds like SCHD are positioned to rebound strongly. A nearly 4% yield plus quality screens plus low-tech exposure make SCHD a compelling long-term play. To continue strengthening your investing knowledge, check out the next videos on the screen, and as always, keep investing.